Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures fluctuating this morning after stocks closed out their worst week since 2023. The weakness in stocks spooking strategists. RBC Capital Markets joining a series of brokers cutting their forecast for the S&P this year. But Treasury Secretary Scott Bessent says he's not worried about the decline that's wiped trillions of dollars from the stock market. Former hedge fund manager telling NBC's Meet the Press the corrections are healthy.
Plus, investors are awaiting the Federal Reserve rate decision this week, with the central bank expected to stand pat on rates as they assess the inflationary impact of President Trump's policies. The decision comes amid softening economic data, including today's retail sales number, which came in well below analyst expectations.
And Nvidia shares higher as the company kicks off its GTC conference today, the week-long event for developers beginning in San Jose, California, with all eyes on CEO Jensen Huang's keynote address due out Tuesday. More announcements are expected on future versions of Nvidia's AI chips after the current Blackwell generation.
U.S. stock futures this morning, they are mixed right now ahead of a big week for markets, more earnings, Nvidia's GTC event, and the Fed rate decision all on deck this week. And we kick things off with retail sales out this morning, missing some of those expectations. Speaking of retail, take a look at some of those retailers that are going to be reporting over the course of this week. You might know them, love them, hate them, whatever. They're going to be reporting and talking about how they're sensing the consumer is being resilient, or trying to be resilient at least. At least from what MasterCard's told me recently, nimble and choiceful is how they're seeing the consumer playing out right now. And more notably for the markets, I think, as well, with some of the volatility that we've been watching over the course of the last few weeks here, especially with last week, one of the worst trading weeks, the worst trading week that we had seen since 2023. I think it's actually going to put even more attention on the triple witching event taking place Friday here, because that is essentially where you're going to see a heavy expiration of options contracts here. And with that in mind, you typically see during that final hour of trade on Friday, that witching hour, a lot of those settlements being and those decisions being forced, and thus inserting even more volatility into the equation. As of right now, options AI looking at a potential move to the upside or downside of about 2.2% for the S&P 500 contracts that exist off of that event.
I think it's interesting that we are having this conversation in the context of those retail sales numbers coming in, still showing a move to the upside, but far less than what the street was expecting. So we'll continue to monitor the street's reaction to those retail sales numbers. But in terms of the market action you're seeing so far, you're seeing a lot of those tech-heavy names, the Magnificent Seven, moving to the upside. The only two decliners in your pre-market are Tesla and Microsoft. So I wonder if we will also continue to be having the conversation just about the health of the consumer this week. We've got FedEx earnings, we've got Nike earnings. What will those tell us about how the consumer is doing, and how will that impact the trade?
And the Fed, too. I mean, how many conversations have we been able to have without even mentioning the Fed? Why? Right. Because the markets essentially, exactly, tariffs has taken more of the prioritization in conversation, and the Fed is really waiting to see how the economy ingests that. Yeah. And so with that in mind, the CME Fed Watch highest probability for a cut, that's not seen till June as of right now, going into this second meeting for the year for the Fed.
The Fed looking for reasons to cut, but right now not getting a lot of it in hard data at least. But the options market is signaling the worst of the stock sell-off could be behind us. The cost of hedging against a 10% drop in the S&P 500 SPY ETF now at a two-year low relative to contracts that profit from a 10% rally, and a potential stabilizing sign for the market. Joining us now, we've got our very own Josh Schaefer. And Josh, it's interesting, I was just reading an article too in the Wall Street Journal this morning about how negative sentiment can often be a contrarian indicator, that you can actually see stocks going up if investors, particularly retail, see signs to the downside ahead. What are you looking at?
Yeah, sure. I mean, I think the question right now among strategists is sentiment negative enough, right? There are certain surveys. You could look at the AAII survey that's been very bearish recently, right? That's a survey of investors. But overall, I think what strategists are arguing is where people are actually positioned, where the money is might not be, quote, bearish enough yet, right? So when you think about just simply where valuations have fallen to, we were very extended from a valuation standpoint, how expensive it was to buy stocks. We've just come back to normal range. It's not like there's a lot of things you can circle right now index wide that are necessarily considered cheap, right? No one's saying big tech is now cheap. The Mag 7 are cheap. The S&P 500 is cheap. They're just a little bit closer to normal. And so I think that's one thing equity strategists are talking a lot about right now. And then I think from the economic side, we've talked a lot about pricing in slower growth, right? Let's take RBC Capital Markets, Lori Calvasina's call from this morning. So she moves her S&P 500 year-end target from 6,600 to 6,200. 6,200, notably, still a decent jump from here, right? What she did with that was move her GDP forecast from somewhere in the 2 to 3s to somewhere in the 1 to 2s. But she pointed out, what if GDP is lower than 1%, right? So what if right now we're just pricing in a little bit of a slowdown? What if the economic data over the next several months are actually worse than we think? That's not fully priced at this point, and that is why a lot of strategists say maybe stocks end the year higher, but over the next couple months, maybe we still have a little bit of chop here and a little bit of concern because we haven't really priced in that much of a slowdown in terms of what we've seen in this pullback.
That kind of mirrors what we heard from Tom Porcelli actually last week from PGIM, who was talking about their view being that they're going to see cuts this year, but they're also making the argument potentially, or they can make the argument for some pretty aggressive, if they did see aggressive tariffs, even more so from here, that they would usher in, or the Fed would be prompted to usher in a more aggressive easing cycle as well here. And so there's the larger question of, all right, for an administration that's now talking about aggressive tariffs, talking about, or at least not talking about, a recession where everyone is prodding with those questions, is there even more that analysts are trying to get ahead of at this juncture and trying to anticipate what the real economic fallout could look like and thus resetting positions?
Yeah, I mean, I think it's just hard, as we've been talking about, Brad, it's just hard to forecast right now, right? And one thing strategists have been highlighting too is when you think about trying to time a bottom, of course, that's very, very hard no matter what. But trying to time a bottom between now and April 2nd, which we know is that big tariff deadline, just seems like potentially a fool's errand, according to some strategists, because that's sort of the big.
What they get paid for.
That's the big day, though, right? That's where you're going to be. So yes, maybe nibble until April 2nd, but if uncertainty is part of what's brought us here, until you have some sort of lifting of that cloud of uncertainty, it's not a market a lot of people want to be in right now. Even you just look at the market action on Friday, a rally led by quantum and AI stocks is not normally a rally that a lot of strategists are going to cheer, right? There wasn't a lot of high quality names leading that rally necessarily on Friday, right? So I think that's why a lot of people aren't necessarily saying, right now, buy the dip, the bottom is fully in. I don't think there's that confidence.
All right, I guess I'll keep my quantum hat in the closet for right now. Thanks so much, Josh, appreciate it. Consumer spending rose at a slower than expected pace during the month of February as worries stir over the strength of the U.S. economy and consumer. Retail sales increased 0.2% month-over-month basis there, below the 0.6% that economists were anticipating. Stephen Junot, who is the B of A Securities senior U.S. economist, joining us here this morning. Okay, so just take us into how you're kind of pulling out some of the pieces of this retail report with the larger kind of read on the consumer, as we've seen through a few data points over the past week and change, just on the CPI and PCE front.
Yeah, well, thanks for having me on this morning. And I think, for us, this was actually a strong report. We were looking at core control to be up a couple tenths. We got up 1%. That's really the number that matters a lot to us because it's the number that flows into GDP mechanically. The headline number was dragged down by motor vehicle sales, but when we looked at the actual car sales data from Wards, that was up on the month. So really what we've seen in the data is that retail sales, we kind of bounced back from that low January and we're right back where we were in December. So you had this weather affected January and now the consumer's back. And really when you think about the fundamentals there, it makes a whole lot of sense. We're still seeing strong job growth. We're still seeing real income growth. And that's really what's driving the consumer. Until you see kind of cracks on the labor market side, you're just not really going to see a big slowdown on the consumer overall.
Are you seeing any signs of those cracks deepening in the labor market, Stephen?
I think it's hard to say. Not really. When you look at challenger job layoffs, you're not seeing much of an uptick in the private sector. Of course, there's that worry with the administration actions. What will happen in D.C.? What will happen in the Beltway? That is happening, of course. We haven't seen it hit the data yet. Now we'll see how that happens. We haven't seen any knock-on effects, but claims are low. Job cut announcements in the private sector are low. And you saw a lot of support there from just general hiring. And I think a generally strong fundamental U.S. economy.
I guess the hang up here, though, is that if we see enough, and what we've continued to hear at least, is that it's the higher end consumer that is upholding this broader kind of consumer as we kind of paint the broad stroke around it. But from what we're also hearing on the employment optimism side, a lot of the highest paid workers out there are struggling or having a longer period of time before they're able to get into new positions if they are experiencing layoffs as well. So that could potentially hit the wage side of the equation, which then circles right back into the broader consumer painting brush that we're using.
Absolutely. I mean, it's just that we haven't seen that, right? So claims is probably the best real-time indicator we have of job outflows, flows from employed to unemployed. And that's what we're watching so closely. If we see that tick up, if we see that move up to, say, 300,000 from where it's running now, which is low 200,000, then I think you're right. We're not in this healthy kind of, I wouldn't say it's not healthy. We're in this environment where hiring activity is soft. That hasn't changed. We're in this environment where finding a job takes longer than it did, say, 12 months ago. That hasn't changed. But we're still in this environment where generally businesses aren't laying people off. And if you aren't laying people off, well, you're still getting income. You're still seeing that income actually turn into real income. So your purchasing power is improving because inflation, despite kind of its wiggles along the way, you're still outpacing that in terms of wage growth. So you're getting about 1%, 1.5% in real income growth. And that's really going to drive the consumer moving forward. But again, I think you bring up a great point. If we see that mount, if we start to see this environment change from a low hiring, low firing environment to a low hiring, high firing environment, and we just don't really see the catalyst there. But if we do see that happen, then you see those downside risks really emerge and you get a lot more concerned about a weaker growth environment.
And talk to me about that weaker growth environment and how much it could potentially be driven by the impact of President Trump's tariff policies on GDP. How are you pricing that into how you're thinking about the health of the consumer?
Yeah, well, I think it's certainly true that we've seen, say, over the last few months, the last couple of months rather, that the downside risk for the outlook have shifted. There's more weight in that left side tail where the risks are really lower in terms of growth. But we're still optimistic when we look at growth overall because you still have this fundamental story, again, going back, I don't want to sound repetitive, but going back to the fact that we do have this fundamentally strong consumer backdrop. Their balance sheets are healthy, again, seeing real income growth. Wealth has taken a little bit of a hit, but overall wealth is still up significantly from 2019. And then you have this structural improvement in productivity where you see productivity really show signs of picking up on a sustained basis. So if you get that pickup in productivity, well, you can get better wage growth that's non-inflationary, and you can get better long-term growth. So those two factors led us to believe that we're probably in a 2% growth environment. But now, could you see the downside risk kind of tilted towards, say, a one handle? I think that's maybe where you're looking at things. But those really haven't emerged yet, I think, in terms of the actual data. Sentiment is one thing, but you really have to see it emerge in the actual data before you want to adjust your view.
Just quickly, while we have you, Stephen, the outlook here for the Fed, and it's not likely that we'll see a cut prior to June. At least that's what the Fed Watch tool from CME is telling us. What is your base case for your anticipated cuts over the course of this year, and what will prompt us to get there?
So we're out of consensus. We don't think the Fed's going to cut this year or next, really. We think that the Fed's juggling with this problem where even if you get weaker growth, well, you're likely going to see higher inflation. So they're balancing their dual mandate, and they're likely to lean on the fact that, hey, we haven't hit our inflation mandate. We're not comfortable unless we see growth really deteriorate to kind of move quickly and cut quickly. So for us, we think the Fed and the general economy will be supportive of current rates, and the Fed won't move because inflation is going to be stuck around 2.5% to 3%. Growth is going to be positive, maybe a one handle, but probably a two handle. And that's going to allow the Fed to just stay on hold for the rest of the year. What would get us there is if those downside risks that you're discussing so much, if we see that emerge and actually drive activity weaker, we see that unemployment rate rise more quickly, then I think that's where you get the Fed to move a little more quickly. And they probably cut more than what the market's pricing in that event.
All right, Stephen, thank you so much for joining us. We appreciate it.
Thanks.
Coming up on the morning brief, we'll count you down to the opening bell on Wall Street. Plus, we'll dig into what to expect from Nvidia's GTC event in San Jose. And a look at quantum stocks. The rally continuing. We'll discuss the names you need to know in the space. Much more after the break.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we got to talk a little Nvidia, the only member of the Magnificent Seven in the green pre-market this morning. It comes as the tech giant's GTC AI conference kicks off in San Jose. But our next guest isn't sure that this will be enough to snap the tech rout here. Ahead of CEO Jensen Huang's highly anticipated keynote address tomorrow, we have Maribel Lopez Research founder, for more on what to expect from the conference. Maribel, thanks for taking the time this morning. What are you going to be looking out for?
I'm looking out for Jensen's discussion of the next wave of post-Blackwell chips and how that's going to enable us to get to another higher level categorization of AI beyond where we are today. I think that's what he's gunning for tomorrow.
And do you think that that is going to be enough to lead to a significant recovery in the stock, just given the amount of selling that we have seen from Nvidia shareholders?
What I see with AI right now is really Nvidia is the best game in town. If you're looking for investing in AI, they're the company that sells the picks and shovels. Everybody's going to continue to buy them for the foreseeable future. But there's still quite a bit of discussion about how do we get back to really extreme growth and better margins for Nvidia. So I think there's going to be some discussion in the investor community about how do we navigate that.
And so with that in mind, you acknowledge what is the major consideration for investors, which is the growth ramp and then the stalling out. And then the other side of that is, okay, the deceleration. What type of deceleration are you anticipating here within that growth figure, and how that kind of measures up to some of the investor expectations?
Where we are right now is the Blackwell chip ramp is back on track. They are actually pulling that in significantly. It's had some impact on their margins, but they're going to sell through on that. And they're looking at the next generations. What we see needing to happen moving forward in this space is there's a 10x performance improvement that will get us to the next wave beyond reasoning, or even more reasoning within an AI. AI is talking to AIs. But that is not a short-term growth ramp. That is not something that you could see really happening in the 2025 timeframe. That's going to be the next wave in 2026. So I think it's going to be a rough navigation period in between. But the reality of the situation is Nvidia is selling everything it can make right now. So therefore, have we priced in that everything that they can make right now? That's a bit unclear. So we'll have to see how the investors are feeling about, do they think that there's more potential upside for the hyperscalers? The hyperscalers have been very clear that they are going to build to enterprise demand. They're not going to overbuild for demand. So really, I think we won't know the answer to this question until we start to see how companies like Microsoft, AWS, Google, IBM, how they're actually positioning what's going on with AI in the enterprise.
And Maribel, I hear you painting sort of a longer-term bull case for Nvidia, but I just wonder what's going to get us back to the prior all-time high that we had in mid-February. Are some of the product announcements and the longer-term plans going to be enough for investors to recover some of what they've lost by holding Nvidia in the short term?
I think in the post-keynote after tomorrow, there's going to be tremendous enthusiasm for the future of NVIDIA, because Jensen does tell the story of how AI will evolve very successfully. He's done that in all of his conferences. But the reality of the matter is we've been very aggressive on NVIDIA stock, and we've been very aggressive as a market on AI in general. And now we're at that rubber meets the road standpoint where will actual buyers be buying enough of cloud computing, AI technology to actually keep this wave going? And I think we've got a good 6 months where there's still a lag between what we want to have happen and what buyers are actually buying.
And so considering the run-up that we've seen and appreciation in the share price for NVIDIA over the course of the larger AI theme, is that still the best-in-class trade for that theme?
If you're looking at AI, they actually are the people that sell AI technology. Every single hardware vendor is standing up strategies at GTC over the course of this week to talk about how they're working with NVIDIA, how they're putting NVIDIA in their stack. So I think that they're going to continue to have high sell-through on their top line for their products. There's no one else in the AI market that is doing the kind of AI sales that NVIDIA has been doing, but that's at a chip level. I mean, everything beyond that is like goes from chips, then it goes to cloud, then it goes to software, and we are just not at the software level yet. So right now, NVIDIA seems to be the game to beat.
Another potential catalyst for Nvidia is quantum, and we spoke with the CEO of D-Wave about their earnings and their quantum supercomputer. To what extent do you see quantum computing as a potential tailwind or headwind for Nvidia, especially given some of that competition that we're seeing?
Quantum is another one of those categories that fits into more of a long game strategy. I absolutely believe that quantum will happen. We've seen tremendous progress from all of the companies that are building quantum this year even. Having said that, most organizations are doing quantum for the research community. It's a long lead time from the research community out into the general enterprise. So I don't think that this is really going to be driving significant revenue growth for anyone in tech for some time.
All right, Maribel, we got to leave it there. Thanks so much for joining us.
Thank you.
And be sure to tune into Yahoo Finance tomorrow for special coverage starting at 1 p.m. Eastern Time of the GTC conference. We will be bringing you on-the-ground reporting from California. Next up, quantum stocks are on the rise ahead of that GTC AI conference from Nvidia. Shares of IonQ, D-Wave, and Rigetti all trading higher pre-market. The CEOs of those three companies will all take part in a panel called Quantum Computing, Where We Are and Where We're Headed, alongside Nvidia CEO Jensen Huang as part of the conference's Quantum Day this coming Thursday. And you can see just the huge run-up that we are seeing in these stocks. It's fascinating to see the degree of D-Wave's run-up. I don't know if we can pull up a longer-term chart, but they've had a run-up happening obviously hugely after their earnings. You can see them, that blue line, clearly the winner at the top of your screen there. And that run-up has continued. It's fascinating to see them up again, another 14% pre-market. Quantum, D-Wave rather, is the company that was able to prove out that their supercomputer was able to do things that a regular computer cannot do. A huge leap forward when it comes to quantum computing. But to the point of our last guest, quantum is a longer-term story. So is it enough for investors to have this bullishness about quantum more long-term when there's not necessarily clarity about the short-term application of quantum? And Nvidia CEO Jensen Huang said that himself, that there's not that clarity on the real-world use case of quantum today.
Right. All of the quantum companies as of right now are going through the same type of practice and exercise of trying to scale. And within that scaling, it's making sure that their quantum computing is actually addressing real-world problems that otherwise classically would not have been able to be solved at the pace and efficiency, similar to what we heard from D-Wave's Dr. Alan Barrett, who joined us last week, discussing about how there is this broader kind of brewing, war among the quantum companies that you're looking at on your screen for quantum supremacy, as he called it. And within that, what you're going to be looking for even more so from their business models is having customers pay on a recurring revenue basis, access the systems, and then ultimately growing out that revenue base over time. Now, it's going to take time. In bookings and revenue going forward from here, it's not just how many of those customers are paying for a one-time problem that they're trying to compute, but making sure that they continue to pay for that access into those quantum systems here. And so what he was saying is that they need to be able to solve useful real-world problems and solve a problem on their quantum computer that cannot be solved classically. That is of great interest to the supercomputing center and significant driver of some of the system sales that they've seen to date right now.
Absolutely.
Whew, that's all the quantum I got.
Well
all right,
said.
let's talk a little Tesla. We know a little bit more about automobiles here too. We've all engaged with those. Tesla, it's back in the red today. It's down pre-market by about 1.75% after attempting to snap its losing streak here. Gains of 3.9% Friday, not enough to push Tesla into positive territory last week, making for the stock's first ever, get this, 8 weeks straight decline, and Tesla shares are down 38% year to date here. We know that Elon Musk has certainly been trying to garner even more fanfare despite his annexation to the White House and President Trump right now, and that has backfired in recent weeks. And so we've seen some of the gains that had been in place since the election essentially evaporate at this point in time. And it's a larger question of, okay, what will the demand profile look like, not just here in the US, but in other parts of the world too, where Musk is, where buyers of vehicles are increasingly critical of Musk.
And this comes, to your point, Brad, amid buyers around the world switching to homegrown brands. We saw on Friday Tesla announcing that they're going to have a 6-seater Model Y available later this year in China, as we have seen their sales under pressure in China, in part due to a lack of availability of more models. So perhaps that is a catalyst moving them to the upside. But again, Tesla continuing to be the biggest laggard of the Mag 7 year to date. We'll have more coverage when we come back.
Wow, there you're taking a live look at the opening bell at the New York Stock Exchange and at the NASDAQ, where Yahoo Sports, our good friends with the sports ball, ringing the opening bell at the NASDAQ. Yeah, go ahead, press that button. Let's take them full screen. Why don't we? We got some good friends over here that we see in the office, and you see all of their work as well. This leading up to March Madness, too, so big time for that team over there. All right, let's take a look at the major averages out of the gate this morning. We are seeing some declines for the Dow Jones Industrial Average right now. That is to the downside by about 0.2% out the gate here. S&P 500, you're also seeing that lower by about 0.1%. This is the look at the year-to-date move. We'll give you the setup going into this week as we're taking a look at year-to-date declines of 4.25% for the S&P 500. Here today, just down 0.1%. And the NASDAQ Composite, I was waiting for that to calibrate here, and ultimately you're seeing that lower as of right now by about 0.2%. We'll round that off to. Let's dig deeper into the 11 S&P 500 sectors. We've got them loaded up here for you on the screen, so you don't got to be searching for them on the interwebs. Anyway, financials, you're seeing that down 0.3%. We are relatively split, as split as you can get for 11 S&P 500 sectors. Staples leading the pack right now. That's up by about 0.3% here. And as we're continuing to look across some of the other declines here, I just want to take a look at a hyper waffle that we're seeing in XLK Technology. Taking a look at some of those other technology names, let's take a look at the tech-heavy NASDAQ 100 here, and chiming in on some of the technology favorites within your household, perhaps, and perhaps within your portfolio as well. You got Apple down fractionally to start off today's activity. We were talking about GTC conference for Nvidia, where we're going to have even more coverage throughout the week. You're seeing that start off the day on a positive note. It's up fractionally as it may be. Still seeing some green on the screen. And Meta, which has been the relative best performer of the Mag 7s over the course of the year to date. Let's take a look at what's holding up there. We're still holding on to gains of about 4% as of right now. Tesla, we were discussing a moment ago here before the break. You're seeing shares there down 40% year to date, down 3.7% here during today's activity. And lastly, we'll just ride out with a look at the 30 Dow components here. I'll put that on a equal view just so you can see where we are trending as of right now. Looks like more gainers than decliners. Nike leading the pack. You got some earnings coming from the swoosh later on this week, and we'll set that up for you just a little bit later on in the show here. But you're seeing Nike and McDonald's, two of those consumer favorites, higher to start off today's trading activity. For a deeper dive on the early tape activity that we're seeing, Yahoo Finance's Jared Blickery is standing by. Hey, Jared.
Hey, Brad, let's take a look at the Dow first, because the Dow had an interesting week last week. So it had the best day on Friday in quite some time. In fact, that was the best day since January, yet it was the worst week since, well, I'd have to go back quite some time here. So suffice to say, we've seen this mixed market, and a lot of times you see some of the best days occur in the midst of a drawdown, the likes of which we're seeing right now. And the big question for traders is, are we close to this drawdown reversing to the upside? And we've seen some fits and starts over the last week. It looks like the market wants to climb higher, but it has been reacting very negatively to a bunch of catalysts. And I do have to note, and here's the S&P 500. You can see it's down 4% year to date. That St. Patrick's Day itself, which is today, has bullish seasonality. And so if we climb into the green today and close in the green, that would be the first Monday that we were able to close green in at least 3 or 4 weeks. The last 3 weeks have been really bad on Mondays. In fact, 2 of the worst weeks of the year or 2 of the worst days of the year have been on Mondays. So that's something that we want to watch out for today. And if we do buck that trend, if we close in the green, well, maybe that's the start of something bigger. Here is the VIX, and what I'm noting here, it's holding above 20, but it is also well off of its high here. It didn't quite reach 30 last week in the midst of the sell-off, and here we are at about 20. That's important because it's kind of a psychological level, but more for me is that we're just coming down off of these highs. It was seeming like the VIX was too comfortable at these elevated states. It was just kind of hovering there day after day, so it's good to see that abating as well. Let's check out the sector action, as I didn't see too much going on in the dollar or the 10-year. Here's energy in the lead, switching places with real estate, only financials and utilities in the red. But I wanted to take a 10-day look. That's the trailing 2 weeks, and that's most of the month of March. As of Friday, all of these 11 sectors were in the red. Energy, you can see, is in the green for 3%, but again, that's only over the last 2 weeks. The biggest loser here is consumer discretionary. That is that Tesla story. That is also an Amazon story that we don't talk about quite as much. But let's go over to the NASDAQ 100. I was noting that the Mag 7 just had its best day. That was Friday, best day since January, along with several other markets, including the Dow. And let's get a 10-day look here on the NASDAQ 100. And you can really see some of the deep selling that we've had. Tesla off 16% in that time, Apple down 10%. But it's not all red. We do see Nvidia with some 7% gains, Broadcom up 3%. So the bull market remains intact, but is kind of still on the knife's edge. So let me get to our leaders for today and see who's leading the pack. Looks like we got IPO. That's an ETF for IPOs in the forefront here. FANG, New York FANG doing well, Korean stocks, solar. What's not doing well, crypto, but I do have to get to futures land because we are seeing copper inch ever so higher. And let's take a look at HG equals F here and see if I can find that on the screen. There we go, up 0.4%. Here is the intraday overnight action, and here is the year to date. And I'm putting this in because these are some of the highest copper prices that we've seen in a long time. And in fact, if I put the max chart on, you're gonna see we are basically, I don't know if we've done it yet, but we're basically at historical highs for copper. So that's a tariff story. So that's a supply story, which is different than the dynamics that we've seen in the past. Want to mention that silver down about 1% today, and I will show you the year to date on that. It is just coming off of its peak here, but still up 15% for the year. So gold not doing much today, but silver kind of giving back some of its gains. And interesting that copper just continues to linger by those all-time highs. Back to you guys.
Jared, thank you so much. It's time now for today's strategy session. It took just 16 days for the S&P 500 to enter into a correction, followed by a 2% rally on Friday. Now investors are asking if we found the bottom for stocks. Joining us now, Mark Hackett, Nationwide's chief market strategist. Mark, it's great to have you on here. Is the worst behind us?
There's certainly signs of a bottoming process. Bottoming processes are very rarely one day like we saw on Friday, so I think it might be a little bit of a churning here, but as you mentioned, the move we saw to correction was the 7th fastest on record. Right. That's unsettling. That's an emotional market. The good news is we've had 48 10% corrections, but only 12 bear markets since World War II. So in general, it's not necessarily that you have a 20% move when you have a 10% move. In fact, 75% of the time, this is kind of what you see. Difference maker usually is a recession. Now at this point, there's warning signs of a little bit, but the data at this point isn't suggesting that.
What are those warning signs?
The retail sales number was a little bit weak. The personal spending number 2 weeks ago also reiterated that. You saw a lot of the retailers were giving a little bit of a cautious commentary, particularly on the high end of the consumer. You talked about that in the last segment. So that is the things that we're watching very closely. But we're not seeing any signs today that we're heading for a recession. Most of it is about worries about data coming down the line. So we're going to be watching that very closely. But in general, one phenomenon we've seen pretty consistently over the cycle is people aren't necessarily doing what they say. So we're seeing a collapse on things like consumer sentiment on Friday. We're seeing CEO confidence weaken. Investor sentiment, as we all know, is historically weak at this point. But we're not seeing necessarily the historical pattern is leading indicators of surveys lead to deterioration in spending. We're seeing weakness in small business sentiment, CEO confidence, consumer confidence, but to date that really hasn't resulted in a lot of weakness in the actual data. It's more about the worries about the data.
This sounds like a personal attack, Mark, because you're basically saying, Brad, you say that the prices of eggs are high, yet you still go out and you buy your bacon, egg, and cheese every single day.
And historically, there would have been a lot more correlation between people getting scared and people behavior changing. What we have seen very consistently since the beginning of the pandemic is people have been acting much more cautious that they're pretending to be more cautious than they're actually being. We're seeing that a lot in the investor side of things too. The buy the dip mentality is still very much in play. regardless of the fact that investor sentiment, bearish sentiment in the AAII survey is at historical levels relative to being at a record high 3 weeks ago. But we're seeing buy the dip behavior. We saw it on Friday. Bank of America data showed that was happening throughout last week. So that has not broken yet. You layer that with the share repurchase activity that's accelerating too. And now you have a little bit of buying pressure that can cause that bottoming process. Again, picking days of bottoms is difficult, but picking patterns is a lot easier.
What's interesting, though, is that we are seeing, in terms of behavior, a little bit of a flight to safety, right? You've got gold at record highs. You've got inflows into money market funds increasing. I believe it was a record at the first week of March for a yearly basis. Does that indicate hedging, or does it indicate concern that we're heading toward a recession?
I guess it depends on the audience. So the retail investor, I believe, is still very much in the buy the dip camp and the allocate to equities camp. 401k participation, for example, is at record highs at this point. Every 2 weeks, whether you like the market or not, generally most of us are buying into the market. That is a behavior that causes a little bit of a tailwind for markets. Institutional investors are a little bit of a different story. Record put buying, for example, is an indicative of nervousness. A lot of the hedge fund activity coming up till last week had been pretty negative. That started to turn around. So I think when you talk about the retail investor, a phenomenon that, again, is different this cycle than in the past, perhaps, is we usually look for institutional investors to be the adults in the room and be the more stable, rational ones, with the retail investor being a little bit more volatile. We've seen that actually in reverse this cycle, where retail investors have pretty consistently been buying equities. Now, they're also buying money markets and bonds, so it's a more balanced allocation. Obviously, the money market returns and rates and bond rates are drawing a little bit of those flows. But retail investors have been consistently buying. Companies have been consistently repurchasing. It's the institutional investors that's the one at the margin.
Really interesting. Mark, thanks so much for taking the time here in studio with us. Good to see you.
Thank you.
Everyone, we've got all your markets action ahead. Stay tuned. You're watching The Morning Brief.
You are looking at a live shot of the NASDAQ with Yahoo Sports Bracket Mayhem front and center. Check it out and fill in your bracket as March Madness is kicking off.
Are you filling yours out?
You know I'm an expert at basketball, so I don't think you want to be in the same March Madness bracket as me, Brad, because
obviously you'll win.
Exactly. I'm being sarcastic just for everyone listening. But check out the March Madness Bracket Mayhem, Yahoo Sports. Well, UBS is the latest bank to boost its price target on gold, saying it could trade at $3,200 an ounce by year end. Gold coming off its recent all-time, with the precious metal up nearly 15% year to date, as investors looking for safe haven assets amid volatility. So is now the time to get into gold, or has it run its course? We got Bob Iacchino, Path Trading Partners Chief Market Strategist, with us for more. Bob, more room to run with gold?
Hey, Maddie, how are you? Yes, there is more room to run with gold, but your sort of trigger point is Wednesday, right? I mean, you look at all the scenarios that we're going through with a lot of deflationary effects being put in by the administration. Tariffs are inflationary, but deportations could potentially be deflationary. Doge is definitely deflationary. So when you're looking at it from that perspective, there are some triggers that could come during the Fed statement and during the Fed speech that could put downside pressure on gold. But when you look at it medium term, we had a really massive sideways correction. It took about 12 weeks between let's call it early November of 2024 to the beginning of January of 2025, and then we broke back out. That's kind of what I expect here. A lot of people look for corrections to be 8 to 10% drops, but there's a such thing with price action experts. I know some, I'm not really one. They call it a sideways correction, and that's what's been happening with gold lately. That shows you that the upside bias is there. I think we're going to get another one of those starting on Wednesday.
What are the remaining upside catalysts for gold at this juncture?
Well, I don't believe in the deflationary story, quite frankly, Brad. You know me long enough, at least to know that I like watching The Bachelor. And I think some of the inflationary things that are still in place and some of them that are going to trigger down the road, Tariffs, for example, a lot of people are calling those inflationary. They weren't inflationary in 2017, but they could be in this particular case because 2017 had a long runway of any other causes of inflation. This time we're sitting at inflation somewhere between 2.3 and 3.1%, depending on what you're looking at, and adding tariffs to that could actually put substantial upside pressure on some parts of the economy. The deflationary impetus is if we actually get onshoring. Gold has a lot of scenarios before it. Not too many of them are bearish. Obviously, you've got stagflation, which would be bullish gold. You have recession, which would be bullish gold, and the potential for inflation to actually kick up with another growth cycle. And if the Fed doesn't respond to that, that's also bullish gold. We're looking at the CME Fed Watch tool this morning. We still have 3 to 4 rate cuts being priced in through the end of 2026. That's implying a recession, and I'm not sure I see that many rate cuts, but gold does.
I wonder, too, how you're thinking about the relationship between gold and the U.S. dollar. Obviously, both are down this morning, and then you've got yields, particularly at the longer end of the curve, moving to the upside as well. When you look across asset classes, what does it tell you about where gold is heading?
Well, in reference to gold's sort of short to medium term, the overall trend in long-term rates has been lower. Since the inauguration, and I'm not giving credit there, I'm just picking a point in time, the 10-year's down around 24, 25 basis points. So that's actually bullish gold. Yes, today we're getting a little reversal of that, but a very little one. So when I look at it from that perspective, you look at the long-term trends, the dollar's long-term trend is really bad. If you look at, say, a weekly chart of the dollar, it's ugly. And when you look at the potential, I'm not saying this is going to happen, but the potential for countries like Germany to rearm, that's spending, that's strength in the euro, which could mean weakness in the dollar that we haven't even seen yet.
Where is gold seeing a divergence versus some of the other precious metals? Is it, I don't want to say the gold standard, that's way too corny here. But as you're thinking about the other basket of precious metals and what's taking place there versus what we're seeing in gold, why?
Well, I think the public is putting on a synthetic gold standard. So I'm actually glad you brought that phrase up, because the more that the dollar weakens and the more that this sort of Trump administration moves toward austerities, and that's what this is, right? I mean, the Trump administration came in saying we have a debt crisis. What happened during the Greek debt crisis a bunch of years back? We saw austerity programs. That's the only thing that saved them. And that's really what Doge is. It's austerity. We're just not using that word. And that particular scenario, again, doesn't really give you a divergence between the dollar and gold or anything else. Gold's not really diverging. It's becoming a synthetic standard at this point. Bitcoin could actually do the same, but right now Bitcoin is way too positively correlated to the NASDAQ, especially to the downside. When you see the NASDAQ weaken, you see gold rally, you see Bitcoin fall. That has to shake loose in order for Bitcoin to become digital gold.
Bob, great to see you here. We will dive into your bachelor projections next time, next conversation.
I'll fill that bracket out for you. Bracket.
Good stuff. Thanks, Bob. Coming up, everyone, we're sticking with commodities and checking in on the latest oil market action. That's next on Morning Brief. Goldman Sachs lowered its oil price forecasts over the weekend, citing a shift in focus to softer U.S. growth from downside risk to Russia and Iran. Analysts now see oil at $71 a barrel by December 2025 and $68 a barrel in 2026 here. Analysts writing the decision reflects two major changes here. First, weaker oil demand as U.S. growth slows, a result of higher tariffs. And the second, higher OPEC plus supply here as well. And as we were taking a look at oil prices, I believe we had WTI up on the screen a moment ago. We got them both for you here. And you can see where oil prices sit right now, where Brent is just above $70.
I think what's important for the call, obviously beyond anyone who is an investor in these commodities in particular, but is what's driving the downgrade here when it comes to the price of oil. And it's specifically expectation of softness in U.S. GDP. So if if you think that there's softness in U.S. GDP that's going to weigh on oil moving forward, what does that mean not only for Goldman's forecast on oil, but for their forecast for the U.S. economy? They talk about rising risks to demand, reinforcing their views that refiners need to be hedging as they could see margin pressure. That also means maybe consumers need to be hedging against pressure on their own profit margins at home because they see a slowdown in U.S. economic growth. And I think that's something that we're going to continue to see calls on for multiple assets, multiple forms of commodities moving forward.
There's going to be a major geopolitical implication with this too here, especially as you consider some of the ongoing negotiations and energy sanctions here. They do note that they're anticipating and expecting prices to recover modestly in coming months as they assume more resilient GDP growth than priced, as you were mentioning a moment ago, but a recovery in valuation and no easing in Russian energy sanctions. That particularly noteworthy, as well as the additive of incorporating supply beats from the exempt OPEC producers, Libya and Iran, most notably there. So it's going to come back down to how those major entities are increasing their production and thus impacting some of the price action as well.
Yeah, I think it's a really great breakdown and just the degree of factors that are weighing on oil and moving the commodity. All right, that's going to do it for Morning Brief. Joining me in the next hour for more analysis on Callis, and you'll have Brad for Wealth after that. Stick around.